And now we wait to see if this goes live. Episode number 5. And now we wait. And once I see this begin, we'll do the introduction. Yes, we're live. We are 5 for 5 now on the TradingView live show. This is episode number 5. We are live with Marc P. Markets. Marc P. Markets is one of the most prolific live streamers on TradingView at this point. He's also always sharing charts and ideas from his profile. What's amazing about Marc is he has been on TradingView for 10 plus years. That's right, 10 plus years of content, of ideas, of live streams. It's pretty impressive. So it was a no-brainer for us to have Marc on the TradingView show. We also got a chance to meet him at a NASDAQ event. So in person, we were hanging out at the NASDAQ event. And when I arrived at the NASDAQ event, which I love, I ran into Marc for the first time in person. But we had met each other before on TradingView. And we look to our left, and who do we see hanging out? Do you remember?
You spotted him. I saw. I'll tell you a story real quick. Right, Ray Dalio. I was in that room with him, not realizing. I'm like, that guy looks familiar, but I wasn't sure who it was. Stefan walks in and goes, "That's Ray Dalio." I'm like, "Oh, I thought that was him." And then before we could even do anything, he ran away. We were trying to take a picture with him.
There was a moment where we both said, "That's Ray Dalio. Should we go get a quick picture?" Exactly. And right before we could go say hi,
he was out of there.
Yeah, but that was pretty cool. So, but great to have you on the show, Marc. And as we get started, we were talking before this. We have a lot to discuss. I think one of the most interesting things, though, for you being a content creator for 10 plus years is to tell everyone about your background in markets and sort of how you got into this content background and how you committing that much time to a craft is pretty impressive. A lot of people do something for a month or two and then they're out, but you've stayed consistent. So I think that's a cool way to introduce yourself, actually.
Well, I appreciate it. First, Stefan, thank you for having me as a guest on here. Obviously, I've been a big proponent of TradingView for quite some time. I mean, as you know, I've been on the platform for many years. To get into like how I got started in this, first of all, the year was 1999, okay? I was just out of school. And I got into being a day trader was like this new concept at the time. It was like this big thing. And it was all over like the magazines. And my father actually is the one that kind of steered me into. He got me this book called The Electronic Day Trader. And the book was written by a guy who ran this firm it was right on Broad Street, right next to the New York Stock Exchange. It was called Broadway. Okay. And so I went to like a seminar there and I was hooked. Okay. It was, I mean, talk about like back in the day, it was a room full of maybe 100, 200 guys with these old CRT monitors. I don't even know if you know what one of those are. It looked like some kind of computer lab with monitors piled on top of each other. And you couldn't hide the P&Ls in those days, like on the computer screen. So you could see everyone's P&Ls. And back in those days, right, I mean, it would say 50,000, 50,000. And this is no exaggeration. Like, this was how much money. And I was so young and naive and dopey that I'm like, oh, this is what happens on Wall Street. You know, it's people make money or whatever. Right? They were making this per day. So I had the opportunity to work in this firm as a trader, a NASDAQ day trader. And that's how I got my start. I had no idea what stock market was. I had no idea what a chart was. In fact, we never used charts, okay? Back in those days, we had a charting computer that two guys had to share, but we used a level 2 quote, okay, which it's not the same these days, but that's how we worked. We had a level 2 quote. We would watch what they called the tape. We would tape read, and we would listen to the S&P futures trade overhead. They had like a squawk box, and we would hear the trades go off in the S&P in Chicago. And we would have to watch our stocks, right? Watch the price action of the stocks and compare it to what was going on in the S&Ps. That's how we made money. Now, the thing was this: people are like, wow, you know, I was only there for a couple of years, but the amount of money that was made, that I made, and that these guys around me made, because I was a small potato. Okay. I couldn't figure out how I was making money. Now, again, I'm not exaggerating here. That was a very unique and unusual time. It's not the same today. It's not even close. But the thing was, people would ask me after, like, even myself, I'm like, how was I even able to make any money? We had two very, very specific advantages that were hardwired into the system at that time, which no longer exist. We can talk about that after if you'd like. But that's what led to everyone in the firm being able to make so much money. If you look at the statistics from that time, the typical trader was still a losing trader. Okay, people that were point and click internet trader, there's research from that time. And most day traders failed back then as they do today. So I'm like, what, we had the most talented people in our particular firm? No, we had two very unique advantages that gave us an advantage over the rest of the population. That is how we were able to make money and make money so easily. Basically, looking back, I was acting as a market maker, basically.
Interesting.
And because I had those advantages, my probability of coming out ahead was greater than someone, your typical trader, like, your typical retail trader today, still had no advantage back then. Although a lot of the talk back then was level the playing field. Now you can be as good as your broker and blah, blah, blah. That was the talk back then.
Wow.
But only certain places had those type of advantages. And you had to be in New York, and you had to have these type of advantages, proximity, to be able to have the ability to do that. So anyway, that was how I got my start. So it's just to kind of summarize how I got to where I am now. After those advantages were not around for long, Stefan. They were only around for maybe a year or two after. And then when the advantages were taken away, no one could make money anymore, right? All these guys that were making all kinds of money, suddenly no more money. I couldn't make money either. And I'm thinking, now I had made some money. So I'm thinking, okay, well, I know what I'm doing. I'm an expert, right? I made money. So after that, I started to trade from home. I wouldn't go to the office anymore. And I'm like, I'll just feel this out. And I just fail after fail. I just could not make money anymore. And I couldn't figure out why. So at that time, that's when I started to maybe this isn't the right business for me. And I wasn't sure, and I had doubts. And, I started to learn about the futures markets, because the futures markets were starting to get attention at that time. We were following the first instance of fake gurus on the internet, because my father, again, He was also involved in this, and he was steering me toward these people. And that's how I started to learn about, other markets and things like that. But I still couldn't make money. And it took me many, many years. Eventually, I got a job at Forex.com. Okay, so I was employed there as a sales rep. And since I was so well versed in the language and in the game, although I was not a profitable trader, I was still able to talk to people about the business and persuade them to open accounts, which is what my job was. And then people on the trade desk, right, at Forex.com would be like, oh, he's a trader. But these guys were just like kids out of college, and all they were doing, they had two jobs. They would margin people out of their positions, right? That was their first job. And their second job was, if they'd get a call for a large order, they had to process the order. That was it. Today I think they have algos that handle all that. But back then, there would be a guy at a trade desk just watching quotes. Hi, can I take your order? I mean, you might as well work at Burger King. It was that kind of thing. So anyway, there was nothing impressive about them. These people, although they had all this exposure and information and access to markets, they had no idea how to trade. Okay, they had no idea. So anyway, after that, I tried to get into my own introducing broker business at the time for Forex. Okay, which basically you would bring clients to a company like FXCM or Forex.com, and you'd get a cut or whatever. I tried doing that, and then the regulations came in, right? Like 2008, 2009, 2010. They regulated that whole thing. So that was a horrible business. And I spent some time there trying to do what I'm doing now, like training people. But at the time, I was nowhere near as experienced as I am now. After that, I got a job at SMB Capital. Actually, I worked for a Russian company for a little while called Forex Club, but they were kind of funny. From there, I then got a job at SMB Capital, which many people are familiar with. They're a New York prop trader firm. They were very famous in 2006 because they were on a show called Wall Street Warriors, which was a show that was run on the Spike TV or whatever. No one probably remembers that. But these guys were like big. The guys that run the firm, they were like,
I actually think I remember that show, Wall Street Warriors. That was a popular show for traders at the time.
Yes.
I do remember that. And I think some people actually do sometimes resurface clips from that show because it's one of the few times where a TV show has directly captured traders in their lifestyle and their element over the course of a series.
Yeah, Tim Sykes came from that show. I don't know if you're familiar with who Tim Sykes is, but he's a big penny stock guy or guru type guy, real big. He came from that show, and SMB was featured on that show. So when I got to SMB, at that time I had my CMT by that point because I've had my CMT for like 10 years now. And they brought me on to educate traders, particularly in the futures and Forex area. But it was, they're a stock firm and they mostly focus on stocks. That's their strength. And I wasn't really a good fit for that part of it. Although I could trade stocks, they wanted me to focus on a new segment. It was very hard. It was very hard. But they were good guys and they gave me a great opportunity. I just was not in the right situation or the right mindset to get that to work properly, although they had a good brand. So from there, I just basically went on my own and I got mixed up with some stuff in like 2015, 2016. And that eventually led me back to where I am now. Okay, 2017, I came back to TradingView, basically, where I started pushing my content with Ethereum and Bitcoin full-time, basically, putting out articles regularly and getting back into like what I'm good at. And since then, I was working with a guy briefly, well, 4 years. We were trying to put a company together, educational kind of thing, but we were not on the same page. So we had to split up. And now I'm on my own. And basically I run a community, okay, with my name on it, Marc Markets. I'm producing content for TradingView, as you can see, and I'm trying to build my personal brand. My goal is, I'm a retail, I consider myself a retail trader advocate. Okay, it's my mission to help the retail trader learn how this game works so that they're better prepared to protect themselves. Because as I tell people, Stefan, in my streams, this is the most deceptive business in the world. And I've seen it all. I can pick out a fraud within seconds, okay? And there's a lot of ways. So what I try to do
really quick,
is
Mark, what I want to say on that too is just as you were introducing yourself and talking about your background and all the things you've seen, I can imagine that because you've seen so much, you now are very well versed in the industry for maybe what it is, the good and the bad, actually. And just curious, it's so interesting as I was listening, you saw the dot-com bubble, you saw the 2008 crash, you had businesses that succeeded and failed. You kind of saw every aspect of markets, which is remarkable. And I think people forget that markets are not just this sort of you start trading and you get rich quick. Like there are some very stern realities here, and it's important for people to know that. I just wanted to quickly just chime in to say that because I just think that's so fascinating at your career and how much you've seen, good and bad.
Yeah, mostly bad. I mean,
wow.
That's the nature of this business. Like I tell people, when a retail trader, we all come in the same way. We all start out the same way. We grasp at the obvious. We're here to make money, of course, right? That's the idea. But the thing is, we don't realize that you can't grasp at conventional ideas. And that goes back to the efficient markets hypothesis. It's not something I made up. It's a theory that's been around since the 1960s. In fact, it was introduced to me by the CMT Association. I never would have learned about that if it wasn't for the CMT Association. Because they give you a strong academic foundation, which is, I always encourage people, go that route first, okay? People right away, they're, what strategy? How can I make money? That's the first questions I get. I tell people, build an academic foundation, learn some of the theories, learn the essence of this game and who you're playing against and how it works before you put any money at risk. Because if I had known that earlier, it would have been much easier. I mean, I struggled for many years and I couldn't figure out what was wrong. Now, when I learned about efficient markets, it wasn't like they sat there and said to me, here's efficient markets and here's why nothing works. It's not what they said. They introduce you to what it is, right? You learn about it. And then, of course, they have arguments for it and they have arguments against it. And since the Market Technicians Association, or charting experts, they always argue against it, that efficient markets is not really true, because otherwise charting would be a waste of time, right? So they always argue against it. And that's kind of like part of what I like to call the lie. They weren't lying, but there's this built-in lie, like we were talking about earlier, that's everywhere. It's prevalent in this business. And it's a lie that plants the seeds of hope, okay? The lie is this optimistic view that all you have to do is learn a few things, and you, too, can pull money out of the markets like a professional. All you have to do is learn a couple of months, and you're good. No, okay? That's the furthest thing from the truth. If big brokers or big people in this business, if they came out with the truth, no one would buy their products. No one would sign up for exchanges, and because there'd be no hope, right? So they always plant the seeds of hope. It's not just in this business. I see it in other businesses too. But this business is particularly bad because money's at risk, and you don't realize the magnitude of money that's at risk. You may start up with $1,000 account, and you think, well, from what I'm looking at here, I can turn this into $2,000 in no time. While the reality is, chances are you're going to go to zero in no time, because there's a lot of obstacles in the way. That first, there are industry obstacles, then there are personal obstacles, and the personal obstacles are probably the biggest. People can't get over themselves. I see this all the time. Very smart people. It has nothing to do with how intelligent you are. This is a game of emotional intelligence. So I tell people all the time, I get engineers all the time, smart guys. And they're like, and they're making all this complex stuff. And they're like, well, how come I can't do this? And I'm like, dude, you're making it too complicated, man. Don't overcomplicate it. But that's human nature. So this is an emotional game primarily. And I tell people that, markets are driven by irrational forces of greed and fear. People are always looking for concrete answers. Why has Bitcoin moved like this? How come Bitcoin moved like that? Why? We shouldn't be asking why. Why doesn't matter. Why occurred 20 minutes ago? It doesn't matter why. What matters is what's next, right? So you always have to be ahead of the market. You have to have a certain mindset. And the smaller the time frames you work, the more of this mindset you have to have. That's why I tell people, if you want to start out in this game, don't start out as a day trader. Start out as like a swing trader or a position trader, because it's easier, it's less competitive.
Whoa,
as a day trader,
we have to talk about that. That's fascinating.
Yeah, sure.
Yeah. Oh, that's so interesting. I've never heard. That's it's just so interesting. Tell us why. Why is it better to start with a longer term mindset, or to swing trade rather than day trade, or maybe even just invest and to watch that investment for 6 months and see what you think of the game, right?
It primarily has to do with, again, efficient markets. You can't beat an efficient market. The smaller the time horizon you work on, the more efficient the market is, right? You have to understand who's on the other side of these trades and why you can't beat them. The guys that really make money in this game, they don't sit there and look at charts like we do. They don't sit there and put, look at get my projection and I'm going to maximize my profit, right? They don't sit there and do that. What they're looking to do is they're looking to make the most money possible with the least amount of risk possible, right? That's not the same as making the most money possible. It's for the least amount of risk. So it's an engineering game, and it really gets into who can get to the exchange first, whose orders can get there first and get filled first. If you're first, you have all the opportunity because you can get the best price, sell it to the next guy a penny higher, and you're out, right? For practically no risk. That is the engineering game that we're talking about, the top of the top. That is what they play. And there's politics involved. You have to have some really smart people working on that. It's not an easy thing, right? That's the algo game. They made this game more efficient, which is bad for everyone else. Because all that money that we made back in the day, that was a result of two inefficiencies, right? All those inefficiencies have been removed. Inefficiencies are where money comes from. So if there's no inefficiencies, then only people with these very unique advantages are going to be able to make consistent profits. And while they're smaller, who cares about a penny? That's nonsense. Well, you do that 1 million times a day, okay, and you're taking very little risk, it adds up, right? And that's the game that they play. A market-making firm, that is the game that they play. That is who you're up against. When they say these Forex brokers, our liquidity providers, who do you think that is, right? So it's in their best interest for you to lose often because you're on the other side of their trades. So you can't beat them. They're not here for you. They're not here for you to win. So they have us all believing, right? I don't want to make it sound like a conspiracy theory, like they purposely do this, but it's just we all on the retail side, we all like to believe in dreams. We like to believe in lies. We like to believe that charts are going to give us the answer to all our problems and we're going to be able to pull money out of the market like an ATM machine, but there's going to be nothing further than the truth. You have to understand, again, like these mechanics that are behind the scenes. You have to understand on an abstract level what's going on behind the markets. And once you can do that, it's called microstructure. I'm not making this up. There's a name. If you Google market microstructure, that's that game. And that's the game where you're competing with engineers. So if you're not competing in that game, then you're like everyone else, right, with no advantage. So is this game a waste of time? I mean, I've been in this game for a very long time. And most of that time I have been unprofitable. The big light bulb for me, because everyone thinks the big aha moment is you figured some kind of magical strategy, right? No, the big aha moment was markets are mostly random. Once you realize that and you realize who you're up against, then your focus goes from, well, how do I maximize my profit to how do I take the least amount of risk possible? How do I do that on a consistent basis? And that's really what changed things for me. And I try to convey this to my followers on my streams. I try very hard, but like you can't lead a horse to water if it doesn't want to drink, right? People still would rather believe in dreams than me telling them that, look, this game is random. Think of this as a random problem, right? Think of this as, like, let me just give you a quick example. Coin flipping, right? There's a thing called gambler's fallacy. And you flip a coin, and let's say you get 5 heads in a row, okay? Now let me ask you, what do you think the probability is of flip number 6? Do you think there's a better chance of getting tails or heads after 5 heads in a row? What would you say?
Well, luckily I am familiar with gambler's fallacy, so it's still 50-50. But there are people who are going to think, well, it can't land heads again. It's already done it 5 times. Yeah,
right.
I know, and it's that happens in trading a lot,
yes.
Especially in downtrends or uptrends. It's very interesting.
General, I tell people all the time, most likely, it's safe to assume your win rate is 50% most of the time. Now, is that a losing proposition? If you don't manage your risk properly, yes. Can it be a winning proposition? It can be if you know how to manage your risk and protect yourself and really wait for unique situations. Right? That's where learning how to gauge probabilities and adjusting your expectations to that, that's where you can improve that. But even at a 50% win rate, you can get by. You just have to understand, what you're dealing with. Does that make sense?
Let me go back actually to, because I don't want to lose my train of thought here about knowing who's on the other side of your trade. And actually in the office the other week, I was talking to my colleague about this. It's just so interesting how many people click the buy button, right? And suddenly the trade is filled. And somehow maybe in our minds we think, oh yeah, there's probably someone just like me on the other side who instantly filled that. But it's fascinating that actually generally the speed of that fill or the speed of that trade is the opposite of that. Actually, most of the times, and just goes back to what you're saying, and I think it is important to talk about, you're not trading against someone like yourself. The equivalent of me isn't pressing sell the same time I say buy. It is a market maker. It is someone on these time frames. It is someone who might have a little more information than you or a better process or far more experience or better tools. So I love that conversation of always knowing who's on the other side of the trade, and curious to hear your thoughts on that. If that's kind of where you were going with that, of knowing, when you press buy or sell, you're going up against some pretty smart people or machines or companies. It's generally not another retail person just like you.
Well, it's going to depend on what product you trade, number one, right? So if you're trading a product like futures, for example, and you're going through a centralized exchange, right, like the CBOE or whatever, then it could be a market maker. It could be another trader like you. It's possible, but there's no way to know. It could be an algo, right? But when you're dealing with a Forex dealer, if you're dealing with one of these cryptocurrency exchanges, you're dealing with a market maker, and there is no one else that you're dealing with. So in that situation, when you're dealing with someone, and it's not a person, it's usually an automated program. It's a robot usually. Okay. When you're in a situation like that, and you're going against the dealer, they know everything about you. Okay. They know how much money is in your account. They know where all of your orders are. They know how much size you have. They know your history. I wouldn't be surprised if they know if your mouse is sitting on like a market order button, not pressing the order yet. But even then, as soon as you send that market order, it knows that it's coming. As soon as you press that button, they know that order is coming. Okay, it's fractions of a second, but they know, and that gives them an advantage because now they know how much size is coming in. They imagine if you could see an order book, like a real order book, and not that crap like you see on Coinbase. I'm talking about like a real order book where you can see people's accounts, you know who they are, you know how much money's in the account, you know what kind of positions they have on, you know how much their margin situation is. They have a lot of information.
Jeez.
So that gives them a huge advantage over you, and
this should
you have to realize that.
But by the way, Mark, just to interrupt for 1 second, this should be a wake-up call to anyone watching. Just at this just how difficult markets are, and potentially who you are going up against, and the information out there. Because what you just said, I've never worked on the broker side or the market maker side, but if that is the case, I think more traders, especially new traders or new investors, should know this before they begin executing, the realities of potentially what could be going on. Because that's I've never really thought about it. I've been trading for about 10, 11 years. Only until the last like one or 2 years have I really started to dive into market structure, microstructure, as you were saying. So fascinating to hear, and I hope anyone watching also is thinking a similar thing.
Yeah, it's a very important topic, and like you, no one cares about that in the beginning. I could care less who's on the other side of my trade. All I was interested in was I need to make money. I need to make money, right? But when you think about why it's so hard, and if you look at there's a lot of research out there that supports this idea or suggests that most retail traders fail, right? If you look at these prop firms, for example, you want to talk about a scam, right? You have all these Forex prop firms that are recently very popular. And one of them released some interesting statistics. And it was something like, and you can actually Google this. Now, you can't believe everything that you see on the internet, of course, but if this is true, it's sad, okay? They said that only 4% of their population of traders, these are people taking the test. You get a prop firm, if you're not familiar with the prop firm, people watching, you can take a test, and if you get through their test, they give you capital. They give you access to capital that you can then trade, right? And then you get large amounts of capital, and they pay you out in the profits, right? That's the whole idea. So they solve the problem for the small trader. You can now be a big trader, right, with their money. That's the idea behind it. So, but you have to go through a test usually, right? So only 4% of traders get through the initial part of the test, and only 1% of them get to their first payout. That's so out of 100 traders, only 4. And you have to pay. These tests aren't free, right? You have to pay for these tests. So like, for example, if you want, a $50,000 account, it's going to cost you $300 or whatever it is. Okay. I don't know the exact prices. And if you fail the test, you're out the $300, and you can take the test again for another $300. Now imagine most people fail those tests. That's a lot of money for the prop firm. If you think about that, right? So what does that tell you? That tells you that most people, right? It's true. Efficient markets, you can't make any money. Most people don't make money. They can't make consistent money. Another point that I want to drive in that area, about, again, being on the other side. I talked to a guy not too long ago. He was a professional market maker on the CBOE, on the floor, and he also worked in New York for a little while. But he's no longer a market maker. He runs another business now. And I asked him, why, he was a market maker for quite some time. I asked, why would you quit? And he said, no more advantage. I said, what was your advantage? He said, proximity and he said leverage, right? And basically he said because markets became so efficient, couldn't make any money anymore. He was on the floor, and he couldn't make any money anymore, right? So as we can see, open outcry, right? These floors, they're no longer a thing, as we know. There's documentaries about that, and they say, oh, these computer traders are evil. No, they're exploiting the inefficiencies in a better way, and when when you can do that, they took all that money, all that inefficiency out of those markets. So no more floor, right? So my point is, when you're dealing with in this game, you have to really question who's on the other side. But this is very important for smaller time frame traders because you're playing in the NFL. When you're on that, when you're playing against them, you're playing it like you're like a Pee Wee League football player. I bring up this analogy all the time. You're like a Pee Wee League quarterback, and you're like, yeah, I'm going to go to an NFL game and I'm going to start as quarterback. You're outclassed, right? You have no chance of winning. It's laughable. Well, that's what retail traders do when they go on their 1 minute chart and they think they're going to be a day trader. Okay. Like I said before, I suggest swing trade or position trade. Now, the competition is not the same on those time frames because you're still dealing with all that random stuff we talked about. But the thing is, now you're working on a larger magnitude, and larger magnitude means greater risk for those guys. And those guys aren't really interested in big risk. They want small risk. So you can take the bigger risk, right, by playing on the larger time frame. But the thing is, you have to compensate for that. You can't sit there and trade the same size you would on a 1 minute chart as you would on a daily chart, for example, because the ranges are much bigger and you can lose a lot of money if you're wrong. So what do? Take smaller positions, right, to compensate for that and stay within proportion of whatever is in your account. It's less competitive, and plus if trends are going to persist, usually they're clearer on a larger time frame. This is why now investors, for example, let's talk about investors, which are the largest time frame. It's boring, but you buy and you hold, and you're always in the market, right? Well, they usually outperform day traders, right? Your typical day trader. Why? Because they ride the trend, and when the trend is on their side, they capture a good portion of it, right? And they make money. That's why when you have a good bull market, like we had over the previous couple of years, everyone seems to make money, no matter how dumb they are, right? They can take a position at the high, it pulls back, and it'll come back, and it comes back, and they make money. Now, these investors take the most risk, okay? They're assuming the most risk because you're in the market all the time, and what happens? The market turns, their bad habits are reinforced, they stay in because it always comes back, and then it doesn't. And all those profits go into the toilet. That's a cycle that happens over and over again. So you have to if you're more sophisticated or you're more experienced, you understand how markets cycle like that. And most importantly, if you can manage your risk in those scenarios, you can keep the money instead of watching it go into the toilet because of bad habits. That's the natural cycle, and that's the the greed and fear that drives the market. I mean, that's sort of like how it culminates, what it culminates into, and why it seems like everyone is making money at some points, and then like a situation we have now, no one's making money anymore, right? Everyone's struggling, right? Day traders, I can't make money. Everyone's like, now suddenly the market's really hard because it's not an easy bull market. 1 minute it looks bullish, you buy the top, it pulls back, you get margined out, because that easy game is gone. So there are times, and there are ways to identify when those times are possible. But that's what I tell people: if you're going to start out in this game, start out on a bigger time frame. Learn the game, and you don't have to watch your money evaporate like you would as a day trader. It's 1,000 times harder, and at least you can get some good habits. And eventually, when you start to accumulate enough knowledge, then maybe you can work your way into the smaller time frame, because the concepts are the same. You just have to understand the competition is not, and you have to compensate for that. You have to adjust for that. So I think that's how we fit that.
And as I was listening, I had some thoughts, and I was sort of thinking while you were walking us through that about about the CMT and that designation. And I know that you're a CMT holder, and the reason why that came up to me was I was just thinking back to your comments on the efficient market hypothesis, managing risk, knowing who's on the other side of the trade. starting out with a longer term time frame and then maybe zooming in if you're new. But I was also thinking about the educational aspect, and I'd be curious to know if you found that having that sort of educational framework, or even maybe like a program mentorship, I guess you could even say to some degree, was helpful to you, and if that's sort of impacted the way you view markets to this day. Just very curious, because I know a lot of people have thought of taking programs like this or joining mentorship programs. So curious to hear your thoughts.
Well, I can't. I mean, the CMT has been invaluable, going through their academic foundational process. I mean, it involves 3 tests. There's a lot going on. You have to get sponsored. You have to have some industry background, but it was invaluable because they exposed me to ideas and concepts that I would otherwise never would have been exposed to. Because as a retail trader, you're only interested in, I have to figure out how to make money off the charts, right? You don't care about these theories, like, who cares? That's academic stuff. Who cares about that, right? That's the initial, and I was also like that, but I got the CMT because I thought it would be valuable to have. And also, at the time, I was employed by a company, so it meant that I can demand a higher salary, right? Because you have more experience and more knowledge in a professional title. So yeah, I have to say, there's the CMT Association, which is technical analysis. There's the CFA, which is that's a fundamental, 10 times harder. You have to basically be an accountant to get through that one. But you have that, like those professional associations. What's great about them is not only the academic foundation that they deliver, and they expose you to real professionals in the business, right? So you're getting real exposure, not some 15-year-old TikToker in the basement of their parents' house telling you they know how to read charts. You're talking to real people, established people that have been in the business a long time. So you're learning from them, number one, and you're making connections with these type of people. You're getting exposed to all types of books. Otherwise, I wouldn't have bought half of these books, but they make you buy these books because you have to learn these topics and you have to be very familiar with them to get through the tests, right? So it's invaluable. But these particular associations, I would say, are a great place for someone who wants to be serious about this business, who plans to be in this business a long time. Like, if they want to make this their business, they should pursue a professional title like that, because there's just so much value that they offer. Also, the CMT Association, along with the other one, the CFA, they impose a code of conduct on you. So, for example, I can't come out and say, well, Bitcoin's going to go to 1 million tomorrow, so let me show you my magical blah, blah, blah. I can't come out with stuff like that. It goes against the code of conduct, okay? And I'm not going to, I spent a lot of money and a lot of time getting this title, and I'm not going to throw it out the window. But even if I wasn't a CMT holder, I still wouldn't say stuff like that. That's just me. But it controls people. It keeps people in line. So you can trust the content that you're getting from an analyst who has a CMT, right, or a CFA, or one of these top tier organizations. Sure, you have some of these made up ones that you pay $50 and you get some stupid title. Yeah, you have those too. You have to make sure you know who you're getting involved with. But with those type of organizations, that code of conduct is very valuable and helpful for the consumer. But as a holder myself, it's actually a liability, and I'll tell you why. The CMT title, because I can't compete with a fraud, right? I can't compete. I can't say the same things that they can say. So you won't find my content. You'll find theirs, because they're lying and they're getting all the traffic. So in that sense, it's a great foundation. But I've experienced that, and I'm not saying that they're bad. I'm just saying that it makes you less competitive if you're going to go into this financial niche, especially if you're going to be a content creator. Something you have to keep in mind, But as far as helping me,
Marc,
in my
Marc, I actually want to quickly say on that there is so much potential for a lot of these social networks and even just digital platforms to take these designations or some aspect of them more seriously, because of what you said about being held accountable and a code of conduct. Because that is really important. As we all know, we've been to YouTube, or you mentioned TikTok, and everyone uses really sensational headlines just to get clicks, traffic, followers, subscribers. But the really smart people who actually went and did the work, maybe not smart, let's just say that intelligent, academic, want to take this seriously, professional, went out and got these designations, but now they can't do the same. So it's almost ironic that the people with the designations actually go to the bottom, and those without it who can. It's terrible for the industry, by the way. It leads to a lot of consumers, traders, investors who are new to the wrong people because of the sensational headlines. It'd be amazing to try to fix that. I don't know what the solution is, but I think it'd be helpful for everyone.
Well, Stefan, you just described human nature. Again, people want to be lied to, right? So the liars are the most successful, they get the most rewards, and the honest people are just tossed aside. But you mentioned, it'd be nice to turn that around. You guys at TradingView have made an effort in that direction, which, I'm very happy about. This thing called the Wizards, right? The Wizards of TradingView. I just learned about that this week, and I'm one of them. So you want to tell us a little bit about that, like how that came about, before I tell you my funny story?
Absolutely. And we should talk about how you were telling me about trying to make this more of a thing when we met at the NASDAQ. But the Wizards came about because there was a need. TradingView has 50 million signups now. There's a lot of people on the earth who are coming to TradingView or creating content on TradingView. And there just is a need to celebrate and award people who are actually taking the time to provide valuable content, trying to help others, trying to be realistic, and giving them some sort of a badge on their profile that demonstrates all the work that they've put into this. It's not about clicks, especially in finance. You shouldn't be interested so much in clicks. It's not about sensational headlines. There is no get-rich-quick scheme. And we are trying to exactly kind of defend against that because it's not really good for anyone, and it is a shame, going back to the TikTok or maybe some of the YouTube examples, that so many financial people are on those platforms getting subscribers with this type of material. And new traders and investors, or even experienced ones, should stay away from it. And so hopefully this Wizards badge, which was just released 48 hours ago or so, will help point people in the right direction. And that's why it was launched. So if you're watching this, go to Marc P. Market's profile on TradingView, and you'll see a little wizard badge next to his name.
Now let me ask you something about that real quick. So do I get like a wizard hat or anything? Do you guys going to send me a wizard hat? Because I'm trying to cover this bald spot with a hat.
I'll say I think there is something in the works. I'm not going to say it just yet, but I believe there is something actually pretty cool in the works for Wizards.
Okay, let me just say this. Make sure if you're going to send me a hat, make sure it's a Lord of the Rings hat and not a Harry Potter hat. Okay, because I'm not a Harry Potter kind of guy. Lord of the Rings is more my style. All right, just want to put that out there.
Noted.
Now, real quick on this story with the Wizards. I was surprised. I was pleasantly surprised to see this. For one, the fact that TradingView has made this effort in the best interest of their users, it's an amazing thing. And I hope people can appreciate that, because a lot of platforms could care less, right? What goes on YouTube, I mean, the fraud and the people losing money, they could care less, right? About the user experience in that way. They say, hey, you're responsible for yourself. TradingView is actually trying to separate, trying to cue you into content that offers real value, okay, not just talk and nonsense. So there's a lot to be said about that, and that's why I think I get along so well with you guys at TradingView. We have very similar ethics, and we're aligned in many ways. Now, funny story. When I went to this, Stefan was nice enough to invite me to the NASDAQ market site, because they had an event there a couple of months back. And like you mentioned before, I was the first one there, okay? And I was so excited to be there, to meet people from TradingView. And Stefan's the first guy that walks in, right? He recognized me, and he's like, hey, I'm Stefan. I'm like, hey, man, right? We saw Ray Dalio and all. We had that little adventure. And then the whole time, I'm like, hey, man, I have this idea. You want to hear my idea? And Stefan's like, well, in a minute, man. I got to network with some people. So I'm following him around. I'm harassing him. I'm like, hey, Stefan, I got this idea. You want to hear my idea? He's like, I got to go to the bathroom, man. I'll be right back. I'm following him to the bathroom. He's in the stall. I'm like, hey, Stefan, you want to hear my idea, man? I want to tell you this idea. And he's like, I'm kind of busy, man. Not right now. So finally, I get his attention. I'm like, Stefan, you want to hear my idea? He's like, all right, tell me your stupid idea. So I'm like, you guys should make like a badge, kind of like the Twitter, the Twitter blue badge. And it should basically designate professionals so that if someone worked in the industry, whether they're like a CMT or they have Series 7 or something like that, so that users can know, oh, okay, this guy is an industry person and this guy over here is not. So it gives them just a better perspective or better way to judge the content that they're consuming. Okay, almost like a product label on a food item that you buy. So I'm telling him this idea, and he's like, yeah, thanks, right? And then I harassed him the whole time. After that, I'm like, he's probably not going to invite me to one of these parties again. And now we have the wizard badge. So I'm like, oh, maybe I had something to do with it. Maybe that was that annoying idea that I kept annoying him with. So anyway, thank you, Stefan, for listening to me and taking my, being annoyed by me the whole time and still, listening. These guys listen. So anyway, I just wanted to say that. I hope you thought that story was fun.
Always listening to feedback from the community. So, I took that feedback and I did share it. Absolutely. But before we go too off topic here, because I do want to bring us back to markets. And one thing was risk management, and we haven't even started talking about charts yet, including the chart that you have up.
You have this chart up here, yeah.
Exactly. So you have a BTC USD chart up at the moment, and we've been talking about risk management, and I see you have some levels drawn, and I want to take us back to that part of the conversation, and maybe you can walk us through sort of what your approach is to risk management, or how you're, how you are finding those levels or spotting those levels. I guess give us the Marc P Markets 101 for how you're marking important levels to plan ahead, whether you're setting a stop loss or setting an entry price and managing risk at the end of the day.
Okay, good question. Well, first, I focus on Bitcoin because it's what I like to think of as a parent market. It's like the S&P of the coins. It's like the parent index. So it really gives us a lot of insight into a lot of other things. It's also sort of like an alternative to gold in a way, right? So especially the way it reacts to the dollar. So I like Bitcoin for all those reasons, but also it's something that a lot of people are interested in. And it's one of the reasons why I focus on it all the time. Because if I write about something else, people are like, whatever, right? If I write about some stupid altcoin, it's good for like 5 minutes. Bitcoin is something that people always have an interest in. So it's kind of a strategy that I have as far as content goes. Anyway, as far as the levels and what I have on my chart here, I train people, right? I have a program and all that stuff. And the first two steps, I have an analytical process that I help people it helps them to extract what I like to call value from a chart, because there's a lot of stuff on a chart that you don't need. So we want to minimize, and we want to take the most important information that we can with the least amount of effort, right? So the first step that I train my students with is trend, right? Trend is pretty easy. You're looking for higher lows, higher highs. We can argue that in this span of time, Bitcoin is generally in a bullish trend, going back a few months here. But as far as the levels go, which is step 2, there are a number of ways that we can determine levels. And again, less is more in this game. I want to keep it simple. I simply go and I look at previous price action. These lines that are drawn on my chart, they've been projected from what I like to call historical price points where action had taken place historically. So going back here, for example, this line that I drew here was not a coincidence. It wasn't because we have this reaction right there. It's because it was a reference point dating back to here. Okay, so those are what I call historical support and resistance. Same with this one. Look at this. All right, is this a coincidence? No. All right, so when we touch those levels again, there is more of a chance that we're going to see some type of a reaction. Why is that? Because these levels have memory. Why do they have memory? Because there are traders caught at these levels. That's why. Okay, so you'll have people, and also you have people looking back as well and saying, well, that occurred there, and maybe it'll occur again. So you have that camp, and then you have people that are actually caught. So for example, you may have people that have, they bought Bitcoin here at that time, they bought the breakout, they stayed in it like a moron, and the market then eventually retests the level. If you had the opportunity to break even, what would you do? Maybe not you, Stefan. Maybe you'd hold on because you're more sophisticated. But a typical guy would be like, man, here's my chance to break even. I'm out. So they sell, right? That's typical human behavior or herd mentality. So that's why, you can expect, and now there's no 100% certainty here. It's just a reference point for a probability. You need confirmations. When the confirmations start to show up, right, because you had your point of reference and you can project that out into the future, you could say, okay, if I get the confirmation, now I can act because I can measure my risk. So like, for example, going back over here where we are now, I have a line drawn here. I just showed you where that line came from. Now I have a little box. Now this is the chart that I use for my articles that I write on TradingView. I have this box. I wrote about this square on TradingView, and I said if the market pulls back into that square, which basically is a reference to this consolidation right here, and I get confirmation inside of that square, it's going to prompt me to call a long signal, okay? So that location was anticipated. I'm not sitting there reacting like everyone else. When we get a green candle over here, and I'm going long. Although I drew this line that you can see on the chart, which was basically one potential scenario out of many working its way to 33K. Obviously, the market chose another path, okay, but I drew this line 2 weeks ago, all right, and it followed half of it, and now here we are. We are in the prime area, the opportune area, the high probability reward risk area, an attractive location. Now, that's great, okay, and the market is going into that area, and I'm anticipating, because we had consolidation here, meaning we have a lot of shorts, right, that are probably happy to break even. When a short has to break even, what do? They become a buyer, okay? We also have new longs like me who want to jump into this thing. So there's a higher likelihood that we're going to see buying activity here, but it's not there yet. So I don't step in front of it, Stefan. I don't say, well, it's at the level, it's good enough, I'm just going to buy it. And if I'm going to do that, I'm not going to go in with a full position either. So it's got to enter the area. That's step one. Once it's in the area, I look for confirmation. That can come in a few forms. But once I have all that, I can measure my risk. Once I can measure my risk, I can set my price target, and then I could put the trade on. Now, when I put the trade on, I don't do that actively. I set up an order ahead of time, and the market has to activate the trade. So I minimize myself from the equation as much as possible. I let the market do all the work, because the more I'm involved, the worse it is. Even with as much experience as I have, I'm still affected by price movements, and I can still be affected emotionally by things that I may see on the chart, right? So I want to minimize myself as much as possible. And once I do that, and the market takes over, and the trade is in play, it's up to the market from there. If I see a conflicting signal, maybe I could make some adjustments. But once it's all set up, let the market do its job. That's basically how I show people how to swing trade, and that's how these levels, that's how they come into play. They're reference points, okay? And as you can see, we have 28K, right, which we're fooling around in right now. If we can get a reversal off of that, you better believe I'm going to be targeting this area, which is the previous high, and then this area, which would be the higher high at 33K, which is where the next relevant resistance is. So I'm using here these support and resistance levels as reference points to give me an idea of what I should be thinking. And then the market needs to prove itself at those levels. Keep in mind, like we always talk about, markets are highly random. It may break through here and just keep going, okay? It can happen. It can go to here. I don't know what the probability of that, like I can't say, whoa, there's a 90% chance of that happening. I can't say that because the market is highly random. All I know is this is an area that's likely to show a reversal. And if I get confirmation of that, I can move forward. If I don't get confirmation of that, I stand aside, okay? That's more of the swing trade mentality. Now, while all this price action is going on, sure, there's plenty of day trade things you can go in there. I'm not going to get into that here. But this is basically the idea and how I use these levels. And it's very simple, right? Less is more. You notice I don't have any oscillators on my chart. I don't have anything magical, even though I'm a wizard now. Maybe I can put some magical things on my chart, but I don't have anything magical on my chart. It's all about using the least amount of information possible to make actionable choices. And a chart, that's where a chart shines. If you know what information to look for, and it's nothing complex. People, they take my training and they're like, oh, that's it? Yeah, because that's all you need. People are so brainwashed into thinking that you need more. I need news. I need this. I need a special oscillator for that. I need to look at the Bitcoin dominance. I need to look at the order book, and it's all nonsense. You don't need any of it. There's certain things you do need so that you can gauge probability. Then you need to be able to gauge your risk. Once you can do that, just get to that point, you can then project your target. My targets are based on risk. They're a proportion of risk. I'm not sitting there with the fib tool. I mean, look, TradingView has a lot of tools and a lot of things you can use. And if you have a purpose for them, or you understand the nature of an oscillator, for example, and it's giving you an output that can help clarify certain things, again, okay, but I don't have any use for those, so I don't use them. And my point is this: when the risk is defined, right? This is what I was getting to. You can project your target. You don't need any tools to do that, because why? Markets are random. Price is random. There's no way to know if the market is going to work its way back up here, although there's a better chance because the trend is still bullish at this time, or possibly the higher high, right? I can only make those assumptions because I'm following the trend in that case. I could be wrong, but the market needs to prove itself, right? And in a strong trend or in a bullish trend, support levels typically hold. They're not compromised. So I should go in with an expectation that the support should hold, or a likelihood that it should hold. If it breaks, that's a new piece of information. It should not break. So if it breaks, now I have to readjust my thinking. That's why I tell people, don't get married to opinions. People get married to these opinions all the time. Oh, in 6 months, Bitcoin will be here. Anything can happen. Some news can come out and Bitcoin could be back at 16K. No one knows the future, although plenty of people claim to know. It's nonsense, right? So that's like the trader mentality. That's where that has to come in. So as you can see, I'm using levels, I'm using price structure, and then I'm basically arriving at a time where I can assess risk. And from there, I can assess a potential take profit. And then it's up to the market. It's up to the random nature of the market to either pay me or take my money, take a portion of my money.
And Marc, I want to speak to something that you had said earlier as well, which was letting the market activate the trade. And I've never heard it phrased like that. So, obviously market orders are probably the most popular order among retail investors, especially new traders. Even an investor who's trying to go long for a long period of time will probably just do a market order. But letting the market activate your order was actually fascinating to hear. So just walk us through that. And personally, I like the aspect that you can set that order based off of the research you've done, off of these levels that might have some action or some significance, and whether support or resistance, and then you get to sit back and wait, which is kind of a beautiful thing, rather than chasing or like you said, letting yourself become a part of the equation. You've totally removed yourself. You've set your order, let the market do the rest. You don't know what's going to happen. I just thought that was really cool. If you have anything more to say about that type of process.
Well, so okay, it's removing it from the equation is a key thing, because by nature we react to things. Okay, people are irrational. They're not rational. People hate to wait, Stefan. Waiting is not a beautiful thing. To you it is, but people hate it. They don't want to wait. They want action. They want it now. They want to get paid now, right? So there's always this thing called the fear of missing out. And when the market's working its way higher, right, you got everyone buying right over here in this area because they fear, oh, this thing's going to go to 40K. And then all the reactionary big mouths, right, articles, oh, this thing's going to 40K, right? So it creates this herd mentality. Using limit orders or stop orders, right, to enter a market minimizes the herd mentality within you. That's why it's such a prime technique. Now, this really pertains to swing traders and more position traders. Day trade, it's hard. You don't have the time. So as a day trader, you have to use market orders, but we're not talking about that game. Okay, most of the time, like if I'm putting on day trades, I'm using market orders. Because you have to. I don't have time to sit there and fool around and be like, I'm going to put this order here. Like, you don't have time. But for swing trades, you do have the time. And you should let the market take over. Let the market make the decisions for you. There's been plenty of examples where I'll call a trade idea, okay, because we'll get a setup, right? Let's say, for example, next candle. Next candle turns into a bullish pin bar, let's just say, right? We get something like this, little pin bar. I'm going to make that a little bigger here in a second so you guys can see what I'm drawing, right? We get a pin bar. Let me make that big. So let's say that's the next candle that we get, all right? Now that right there is the type of reversal that I would like to see in such a location for a swing trade long. A situation like this helps me define my risk. I could say, okay, my risk is defined by the bottom of the candle, or I can look at the swing low and I can say I could define my risk there, right? But I have at least a confirmation that's telling me there's a reversal taking place. A pin bar is an official reversal candle. So once I have that, I have enough information now to put on a trade, but I'm not going to sit there and just react and take a market order. And the reason is the next candle may open, right? It may not take out the high of the candle. It may not do this. Instead, it may do this. Okay, how many times have you been in that situation? You're like, oh yeah, this thing's turning around. And the next candle looks like that. You're like, oh, that's no good, right? By letting the market tap you in, you can help filter out these situations. Now, it's not perfect, but there's been many instances where I've called a trade, like, okay, we got the pin bar, but then the pin bar never activates. And the thing sells off, takes out the low, and would have hit the stop, but we never took the trade because it never activated, right? So instead of using our intuition and, yeah, I'm a trader, right? And we get into the market thinking we're cool, the market never tapped us in. So it's not up to us. It's up to the market. Now, of course, there'll be times when it does tap you in and it goes to the stop. That can happen too. Right? There's no perfection to this. There's no perfect way. We're dealing with probabilities. But if you take 10 trades like this or 20 trades, with the pin bar, there's a higher likelihood that the next candle, right, should look like this. That's what it theoretically should look like. And there's profit potential in there. Now, again, there's no guarantee, of course, that it's going to do this. There's no guarantee, but there's a greater chance. We're playing probabilities here, something we can't see. So people always ask me, Stepan, they say, well, how do I know, okay, so the market got me in, right? They followed all that. They put the buy stop order. They're in the trade, but they don't know where to get out, right? They're like, well, how do I know if the market's going to go here? Or how do I know if it's going to go higher? Because I want to maximize. You got to get out of that mindset. Okay, that's the greed mindset. You have to understand that if you embrace that market's random, you realize that profits are just a gamble. It can turn anywhere in that box. This thing can turn, right? So what you have to do, and this is how I train people. I tell people, you look at your profit is a function of your risk. If you're risking 100 points, okay, you multiply that number times 2, and you add that to your entry, and that becomes your profit target. So if it goes there, you make 200 points, but you were risking 100 points. You do that 10 times, and you're at a 50% probability, you should still come out ahead because you're making more than you lose, right? So there are many variations of that, but that's the basic idea. And there's a number of ways you can arrive at, determining that risk and generating that profit. But typically, you want to generate that profit target from how much you risk. And all of that can be done in a very simple and routine way. So again, by doing that, you're taking yourself out of the equation. You're not sitting there and saying, well, I hope it goes higher. I hope it may go higher without you, but that's none of your business. You're out, right? If you're able to take 2 times what you risk on every trade, you will be fine. Okay? Who cares if it runs another or whatever? Here's what people don't realize. These big runs, they occur sometimes, but they're infrequent, right? So what you want is frequency. You want something that's going to reach your target with a higher probability. That's why I tell people, just go straight to 1.5 to 1. You should take something off the table. If you're at 1.5 to 1 reward risk, take something off the table. If you want to be more aggressive, okay, wait for a conflicting signal. But you should just take something off. It's a good habit to be in because you're making 1.5 times what you're risking. Over time, your account should see a positive growth. Okay, does that make sense?
It doesn't. And what I want to say about taking some off the table is, no one ever complained about taking a profit. But what I often hear people complaining about is the shoulda, woulda, coulda. I could have sold there, and now I'm underwater. And there is an element of just setting that simple risk reward. and take your profit when you can. Mark, what I do want to go back to, because also, by the way, I really like watching the way you draw those candles. I haven't seen that before. To use the rectangle tool to draw the candles, that was pretty cool. I want to talk about the simplicity of your chart in general, and is this really how simple you keep it? No volume, no moving averages. You just like support, resistance. That's it.
For this time frame, yes, I keep it as simple as possible.
Got it.
If we're talking about day trades, I may use some more things that are I guess you can judge as traditional, but I only do that to smooth out price action so that I'm focused more on the general direction. But it's only, again, it's just to smooth out certain things. Like I know what I'm using it for. If I have to use like a moving average, I'm not opposed to it, but only for small time frames. We're talking like, a 1 minute chart or something like that. When you're dealing with these larger time frames, simple is better, less is more. So I try to use the least amount of information possible. A moving average is just basically price smoothed over time, right? And it just gives you a line that the price is going to basically mess around with, right? But that's all it is. So they don't really serve any other purpose. They're like a lazy trend line, right? So they're a trend line that you don't have to draw. So they can kind of give you just some visual cue, right? That's how they can be interesting, but smaller time frames, because smaller time frames can be extremely noisy, right? Larger time frames are usually less noisy. So I don't need so much help on a larger time frame. And that's why I'm a big promoter of keep it as simple as possible. Less is more, and it's true, especially with this game, considering that most of the information that we consume is useless, right? If you're consuming tons of useless information, how is that going to help you? People think more is better, but it's not in this game, right? Because there's no advantage to 99% of the information that we consume. And that's why we have the herd mentality. That's why we have everyone losing their money all the time and, not understanding how this game works, on a statistical level. And you really have to look at it that way.
And speaking of the simplicity too, the other thing I noticed is you like the 24-hour chart, and I think that's cool. The one thing I always see is daily chart. So 24 hours, is that specifically for crypto because it's a 24-hour market, which is a great reminder to people who trade crypto. If you really want to get a whole day, a candle that's a whole day, 24 hours, I suppose, is something to look into.
Well, I just, this comes probably from working with smaller time frames. Like if I'm working with 1 minute charts and 2 minute charts and 5 minute charts, and you're working with 240-minute charts and you're working, that's kind of like that's where that came from. There's really no purpose for that. Like it doesn't matter if I put a daily chart or a 24-hour chart, it's serving the same purpose. But I think I just have that on there because of the units of time that I've worked with on smaller time frames. I've used tick charts. I've used every kind of chart you can imagine. So I think that's how that came about. But there's, some people ask me about that. It's interesting that you notice that detail. Most people don't.
No, I think it's well, I like the simplicity aspect, and I think that's very important because it is easy to get too noisy. And I was just trying to understand just the full capacity of the chart, and I noticed that, which I thought was unique, and I do want to try it. And speaking to the simplicity, someone told me the other day that we are essentially at our information pollution is just at all-time highs. It's never been easier to get information out there. It's never been easier to share some sort of news or do some sort of analysis. And all you can really do now is control for that pollution. And I thought that was so interesting to think of it as pollution. And I wonder if that's kind of where you're at as well, where you prefer so much less information because there's just simply too much, and you're trying to just make things a little more simple and crisp for your process.
I've always been a big proponent of being a contrarian, right? So in order to be a contrarian, you have to go against what everyone is thinking and saying anyway. It's not an easy thing to do because we're wired to be followers. We're naturally wired to be part of the herd because there's safety in numbers, right? This goes back to like prehistoric man. And because of that, right? So all this information, people just, they consume it because they think more is better. I've gotten away from it as a contrarian. I've always learned to filter it out. I mean, this goes all the way back to like when I first started out. I realized certain financial channels, the mainstream channels back then, I realized very early on that they were full of nonsense. This was before the craziness we have now. Pollution is a very good word. Yeah, it's all because you have to understand what they're incentivized by. That's a really key aspect of the whole thing. Whether you're a news anchor, a reporter, or a content creator, you're incentivized by attention. So you're capitalizing on people's attention. You monetize people's attention. So you're going to do and say whatever you have to do to compete in that cloud of noise to get more attention so you can monetize it. Right? So what does that say to the quality of the information that you're consuming? You're going to be consuming garbage because basically people just want your attention. And you may say, well, but I don't click on the ads. If you're exposed to an ad or whatever, someone's getting paid somewhere. And that's what drives them. If driving them, if we had like something else, like, hey, produce high quality, actionable content that provides real value, we would, and they were incentivized for that, we'd probably have a landscape that's, completely different from what we have now. So that's one thing you have to understand. It's like what drives that content creation, and that's what it is. So, and also, people like that all those messages that are built into that, right? That's what proliferates the herd mentality. Just look, every time, when I do a stream, sometimes someone will come to the stream and say, oh, can you pull up this coin? And I pull up the coin, an altcoin, and the coin is vertical, right? It looks like this. It looks like, it looks literally, the candle looks like that. And I'm like, oh, man, right? And usually you get that as a result of some news, some fake news, some kind of pumping, promotion, blah, blah, blah. It catches everyone's attention, and everyone thinks, oh, this thing's just getting started, right? And the first thing I tell people, because this is the herd mentality, the first thing I tell people, if you buy it up here, all you are doing is making the guy rich who bought it over here, okay? The guy that was in before you. People assume, Stefan, people think in a very egocentric way, and they assume that when new information comes out, that they're one of the only people that know this information, okay? Meanwhile, everyone has access to the same information, right? Just like when everyone's a millionaire, no one is a millionaire. If everyone has access to the same information as you have no advantage. So that's why getting away from information that offers no advantage is a benefit rather than a liability. People see it the other way around. I need to be informed. Yeah, cool. If you want to sound cool at a party and you want to impress women, yeah, great. You could sound informed. But as far as making money, it's not going to help you. So I've seen plenty of examples of this. And I've isolated myself completely for quite some time. People can't understand how I make calls and they work. And I have no idea what's going on in the world. I have no idea, right? Like, this Bitcoin news came out yesterday. Like when that FTX thing occurred, we were short, okay? My group was short. I had no idea what was going on with FTX. Next thing you know, right, that was back here. Let me just pull it up on the chart. Let me just show you. That was back here.
Mark, I have to say on that two really cool historical stories on that, actually. One, which I've actually said before, and it's not my quote, but I love to resurface it. It's the old... show me the chart and I'll tell you the news. I love that quote. And the other one too is we could talk about this all day. And by the way, we're passing that hour marker, so we'll have to wrap up the show shortly. But I wanted to say is I believe there's a story of Nicholas Darvis, or I think it was Darvis. It was some trader who went up into the mountains for 2 or 3 years and traded with old newspapers. I think it was. No, he traded. He traded following price action and then went back and read the news. And there was some story about how interesting he saw that the price action was foretelling, that was happening before the news, which I thought was so interesting. And just maybe to some aspect of maybe someone knows something somewhere. I don't know. But I just wanted to say those two quick stories because I think they tie in perfectly with what you're saying. Let's talk about this FTX move quick, and then we'll wrap up the show.
Okay, cool. So yeah, I mean, again, what you said, going back to like efficient markets, one of the things that efficient markets says is that all the known information in the world is baked into price moment to moment, right? So the only way you'll have an advantage over that is if you know something that the world doesn't know, meaning inside information, which is, of course, illegal if you trade on it in most areas like stocks and things like that. Like it's a crime to trade on inside information, unless you're a politician. But besides that, all the information in the world is priced in. So which means you can actually trust the price because whatever's going on in the world, it's being baked in. A lot of times, like when NFP comes out, we get one of these economic events. I don't check the event, right? I know the event's coming out. I wait a few hours after the event. I look at the price action and I say, oh, they must have raised rates, right? I have no idea if they, and then I look at the news, oh, they raised rates. How was I able to figure that out, right? Because I recognize by the price action, well, that would be the type of reaction that they would get if the Fed said this, for example, right? So people are all obsessed with, what is every little word? Just let the market figure it out. There are a lot of smart people out there, big funds, big, well-financed people with better information than us. They're going to take a position. Let them do it first, and then I follow, right? That's the essence of price action, and why I tell people, don't trust people, trust price, because price can't lie. Price is a reflection of all the known information in the world, fundamentals, whatever news, whatever is going on. So you don't need any of that information if you can just trust the price and information that's derived from price. That's why candlesticks is so valuable. But
Mark, I want to
go ahead.
I want to say that is actually a really cool way to end the show. Something I've never heard before, which I think is almost worth repeating quick. And maybe it's what you were saying, but it's how I started to interpret it, which is using the efficient market hypothesis almost to your advantage, because you're sort of accepting it for what it is. You're accepting that all the information is out there. Thus, don't try to be the hero. Don't try to take unnecessary risk. Let the truth of the price tell you what's happening. I think that's a fascinating way to sort of wrap up our show. And I've never heard it like that, because I've always heard people be on one of two sides. The efficient market hypothesis isn't true. Don't hurt my dreams. Don't crush me. I can beat the market. So can anyone. And then there's the other side that says no one can beat the market. Efficient, EMH is real. But then now you're actually kind of bringing some sort of like third element to this debate, which is use the efficient market hypothesis to your advantage. Accept price for what it is.
Stefan, actually, that's not something that I came up with. That's something I learned from the CMT Association.
Fascinating.
They argue against it, but then efficient markets there's some arguments for it. But people do make money in the markets, so that means it's not entirely true. You just have to understand it, and it goes back to the basic tenets of technical analysis. And one of them is price is a discounting mechanism, which means price accounts for all the known information in the world. So if that's the case, that means markets are random, and that you're not going to know where it's going to be 6 months from now, because there's no way to know, because there may be news that hasn't come out yet, right? Russia may invade another country, for example, right? No one saw that coming a year ago, and the market will have to price that in because it's not priced in right now, right? So that's why these people get me who they say Bitcoin will be at $1 million in 6 months. It's like, what other lies are you going to tell us? Because there's no way to know with any degree of certainty. Maybe some news comes out at the time and the market will have to readjust. But when news hits the market, it has to adjust if it's not priced in, right? And that's when you'll see, like, for example, a non-farm payrolls report, and you'll see a really dramatic move in the market because maybe there was a surprise that the market was not expecting. And then now it has to price it in. Like if Chairman Powell came out and he said, we're gonna go from raising rates to we're just gonna start cutting rates. That would be a dramatic surprise. The market is not expecting that, so the market would have to adjust, right? That's efficient markets hypothesis in action. So the market, if he came out and said something dramatic like that, you'd see the S&P up 1,000 points, like in 5 minutes. That's how dramatic it would be, because all the shorts that were expecting one thing would all have to get out. All these new buyers would rush in. There would be an adjustment in expectations or the perception of the future. They say the market trades in the future, whether it's stocks, whatever it is. Markets trade in the perception of the future, perception. So whatever we have that perception now, that's how we're going to trade. And then when something new comes out and changes our perception, it changes, right? That's why you can't forecast and say, oh, the markets will be here in a year, because there's no way to know. Does that make sense?
It does, and I think that's the way to end it, because it kind of takes us back to the beginning of the show as well. So with that being said, Marc, episode number 5 of the TradingView show has concluded. Thank you so much for joining us on the program. We went over an hour and 15 minutes, which is going to be our longest show ever, by the way, which I think is cool. No, I mean, I really am curious to see how people respond once the show starts to circulate, if they enjoy the longer show. So the feedback will be interesting. I know I enjoyed it. I thought we got to go a little deeper and we could really focus on some specific subjects.